I've been stacking physical silver for over a decade, and I started this channel for one reason. I got tired of watching the story show up on TV 6 hours after it already played out on the screen. So let's talk about what just happened today, because if you follow metals, you already know these aren't normal numbers. Silver is trading around $90 an ounce, gold pushed through $4.600, platinum is above $2.400. In a textbook metals bull market, those kinds of moves don't just lift the miners, they usually light them on fire. Juniors especially tend to act like a leveraged version of the metal. When the commodity price rises, margins expand faster than revenues because a huge chunk of costs are fixed. But that is not what's happening. Instead, the mining equities, especially the junior silver names, are acting like someone put a weight on them. And the bigger silver goes, the more obvious that weight becomes. In this video, I'm going to do 3 things. Show you the divergence that has no business being this wide, explain a very real market structure force that can create this kind of behavior, options, pinning, and dealer hedging, especially into a major expiration, lay out the 2 most likely paths for the next 48 hours, and what I'm personally watching into Monday. Quick disclaimer. This is educational, not financial advice. I'm not telling you to buy or sell anything. I'm walking you through a setup I'm tracking. Now let's get into the data, because the chart is telling a story that headlines are not. Pull up silver on a chart and it looks like a vertical staircase. Strong bid, shallow dips, buyers stepping in quickly. Now put that next to SILJ, the Junior Silver Miners ETF, and you get something that feels almost backwards. You don't see the kind of momentum you'd expect. You see choppy action, failed breakouts, and heavy selling whenever it tries to get traction. And it's not subtle. There were moments today where silver was pushing higher, and right as that happened, the miners got hit hard. Not the metal, the equities. The exact instruments that are supposed to represent the operating leverage trade. That mismatch is the entire point of this video, because if silver is near 90D, the mining sector should be pricing in fat margins, improved cash flow, and a wave of speculative capital chasing torque. Instead, the sector is priced like we're still stuck in a completely different regime. So either the market is seeing a fundamental problem that most people are missing, or we're looking at a market structure event where price is being guided into a zone for a reason that has nothing to do with long-term value. To measure how extreme this is, I use a simple gauge, not a perfect valuation model, just a pulse check. Here's the gauge, SILJ relative to the spot price of silver. Again, this isn't me claiming one should equal the other. An ETF is not a commodity. A miner isn't a bar of metal. There are political risks, dilution risks, hedges, and company-specific landmines. But as a relative performance indicator, this ratio is extremely useful, because over time, miners don't stay this disconnected unless something is forcing the disconnect. Right now, the SILJ to silver ratio is sitting around 0.33, a level that's historically depressed compared to prior periods. To put that in plain English, when silver was far lower, back when it was trading in the 20s and 30s, CJ was behaving like a true leverage vehicle. Today, silver is dramatically higher, but SILJ is behaving like we're still in a sluggish, pessimistic tape. If that ratio merely returns to a more typical zone, nothing euphoric, nothing bubble, like the miners would need a big move just to catch up to the metal's new reality. And that leads to the obvious question. If the fundamentals are so strong for the metal, why is the equity leverage trade acting dead? Most financial commentary will hand you the usual answers. Mining costs are up. Margins aren't what you think. Political risk is rising. Miners always disappoint. Some of that is fair. But it doesn't fully explain the timing and the behavior, especially the way miners seem to get pressed right when they approach key levels. Which brings us to the piece most people ignore, options market mechanics. Let's keep this simple and real world. A huge amount of capital doesn't trade miners by buying shares. It trades miners through options, calls and puts on ETFs like SILJ and on individual names. When dealers and market makers sell those options, they don't just take the other side and hope. They manage risk dynamically by hedging with the underlying shares. Here's the key idea. As price approaches popular strike levels into expiration, hedging flows can start to dominate price action. That can create 2 very different effects. One, pinning the magnet effect into a big options expiration. Price can get pulled toward a level where the option market's net payout is minimized, often called max pain. Not because a villain flips a switch, often because hedging flows naturally dampen movement and pull price into a zone. 2, the gamma dynamics, the feedback loop effect in certain conditions. If price breaks through key strikes with heavy open interest, hedging can flip from dampening to accelerating. Dealers may have to buy as price rises, which pushes price higher, which forces more buying. That's how you get fast, violent moves. Now here's why the next 48 hours matter. A major options expiration hits January 16, 2026. When you have a large expiration and a market that's already stretched and emotional, you get one of 2 things. Price gets pinned into the close, or price escapes the pin and volatility expands aggressively. And if you've been watching SILJ, the trading has that contained feeling like every attempt to run gets met with supply. I'm not calling that proof of manipulation. I'm calling it consistent with a market that's being dominated by expiration-related positioning. So the right way to approach this isn't to yell, "rigged." The right way is to ask, what evidence would confirm or deny that option's positioning is the driver? We'll get to that in the plan section. But first, let's be honest about the bear case, because there are real reasons miners can lag, even in a raging metals tape. If I'm wrong, it won't be because silver isn't strong. It'll be because mining equities carry risks that physical metal doesn't. Here are the two biggest ones: risk they want in coastal execution. It's not just the metal price. Yes, silver at 92 implies massive potential margins. But mining is messy. Grades change. Recovery rates change, unexpected capex shows up, labor contracts reset, energy spikes, permits slow. The top operators can still print money in a high-price environment. The weaker operators can still destroy shareholder value even when the commodity is booming, especially if they issue shares at the worst possible time. So when people say miners don't move because costs are up, it's not automatically wrong, it's just incomplete. Risk fate, TUI, political and tax risk. When metals get expensive, governments pay attention. If silver is making headlines at 90D, the jurisdictions that host mines notice. Royalty structures get revisited. Permitting becomes political. Windfall taxes become a talking point. That matters, especially for juniors operating in tougher regions. But here's why I'm not satisfied with those two risks as the full explanation. If the entire sector was repricing purely on fundamentals and risk, the action wouldn't look so mechanical into key levels. It would look messy and news-driven across names. Instead, what we're seeing is a broad suppression of momentum in the miners, while the metal itself remains firm. That's why I'm treating this as a timing and positioning story, not a long-term miners are broken story, which brings us to the next 48 hours. I see two realistic scenarios. Scenario A, the pin holds through Friday's close. If dealers are heavily exposed around certain strikes and hedging flows are dampening moves, you can get a quiet close, even in an otherwise wild macro environment. In that case, what I'd expect is SILJ stays contained into Friday, options expire, then on Monday, the market reopens without that same expiration gravity, and that's where you often see a catch-up move, because the flow that was suppressing momentum is no longer the dominant force. Scenario B, the pin breaks before expiration ends. If SILJ starts reclaiming key levels and pushing through heavy strikes with volume, you can get the opposite, hedging flips into a momentum amplifier. That's the scenario where you can see sudden gaps, large intraday candles, moved 8% and you blinked, type action. The problem is that scenario B is also where traders get chopped up because volatility expands both ways. So instead of predicting which one happens, I'm watching for confirmation signals. I'm not changing my core physical stack based on 2 days of market structure. Physical is my long-term insurance. But for miners, this is what I'm watching. Once in SILJ, price behavior around key levels, not opinions. Levels, if SILJ breaks out and holds, not just a spike, then the contained narrative weakens. If it keeps failing at the same zones with heavy volume, the pin narrative stays alive. 2, volume must close location, the most underrated signal. I care less about intraday drama and more about where it closes. Strong close near highs, buyers absorbing supply. Weak close after a run to supply, still in control. Third, the CLG to silver ratio. Stabilization matters more than the low. If the ratio keeps bleeding lower, I'm not interested in guessing bottoms. If the ratio stabilizes and starts turning while silver holds strength, that's when catch-up trades become more attractive. 4, Monday open. Gap the follow through. If Friday is pinned, Monday is the tell. Gap up with follow through positioning, unwind, repricing, gap up, then fade hard, still trapped, flat open, but silver stays high to divergence remains, pressure builds, and most importantly, position size and risk high. Beta miners can humble you fast. I'd rather be late and right than early and forced out. So that's the setup. Silver is in rare air. Gold is in rare air. Platinum is awake. And the juniors, through SILJ, are priced like none of that matters. Either this is one of the cleanest catch-up windows we've seen in years, or it's the market warning us about a risk the crowd is ignoring. By Friday's close and Monday's open, we'll have a lot more clarity. If you want, in the next video, I'll pull up the options chain, the biggest strikes by open interest, and how that lines up with SILJ's chart levels, because if this really is an expiration-driven trade, the options data will leave footprints. Until then, keep your eyes on the close, not the noise.